Good afternoon, ladies and gentlemen. Thank you for taking the time out of your busy schedules to join our quarterly update, the third installment for the year. Just before we dive in, a few housekeeping rules here, just so everybody's on the same page. This webinar is being recorded, and a recording will be shared on our YouTube channel and social media for everybody to view at their own leisure. If you do have any questions, please put them in the Q&A section or in the chat, which goes straight to the panelists, and then we can get towards them in our Q&A session. We will be having a dedicated session just for questions towards the end, so please save them for then. Naturally, if there is anything that's relevant during our discussion, one of the panelists will pick them up during our session here. Now, before we get started, a few disclaimers to go through for compliance purposes, so please just bear with me. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale, purchase of any specific securities, investments, or investment strategies. Investments may involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Now, with that out of the way, as we're still letting a few people join into this Zoom webinar session here, why don't we get our first poll up here right now on screen for the audience that is here right now. And this one's about Thanksgiving of all things. It's just a couple months out now, and before you know it, it'll be right upon us. So if we could take a quick stab at that poll, hopefully, Brian, I think you've got the poll up there right now.
It should be up now.
Oh, wonderful, excellent. So we'll give the audience there a few minutes to answer that, and then we'll get to the results, which will be our little trivia bit before we move on. Okay, looks like the answers are coming in. All right, folks, I think that's enough time. You only have a few options there to choose from. So yeah, we'll move on, and hopefully you can share the results there, Josh or Brian. But if we move forward, there you go. There's the majority of the respondents. Overwhelming 42% will be spending Thanksgiving at home with family, as it should be, I suppose. But yeah, I don't know about you, Josh, but where are you spending your Thanksgiving?
I'll probably be here in London, actually, spending it with some friends. I imagine that it's not high up on your list of priorities, though.
Got it. So you're part of the 17% than the 42.
Mm-hmm.
Got it.
I'm guessing you're not really big on it.
Cam, have you actually done a proper Thanksgiving?
I have not, which is why it's a great segue for you to invite me to one of your Thanksgiving sessions, probably.
Gosh, we're gonna adopt Cam this year. He's gonna be our adopted American, and
exactly. You'll have to show me the proper way to celebrate Thanksgiving. Perfect. With that little bit of trivia out of the way, hopefully we've got all the audience nice and comfortable here. Before we dive into our actual agenda for the quarterly update and looking at what's going on with the macro framework, but also the markets and everything else in between, as we're getting towards the end of the year, we've got a few financial planning and overall end of year planning aspects that my colleagues Isa and Josh will be running us through. So with that said, Josh and Isa, if you guys can make your way over to the screen, and why don't we tackle some of the end of the year aspects that clients should be keeping an eye on?
Absolutely. So yeah, thank you for passing that over, Cam. So naturally, as we get closer to the end of the year, it's a great time to not just look forward to the next year ahead, but also to take stock and make sure that we're keeping track of our whole financial plan in general. So what are some different pieces of that? Well, the way I would look at it is we'd start with tax planning, which is a crucial part of any year-end financial strategy. The first aspect we want to consider is tax loss harvesting. This involves evaluating your investment portfolio for any underperforming assets. Selling these off can help offset capital gains that you normally pay taxes on. So optimizing your tax bill at the end of the year by harvesting the losses, hence the term. These losses can be carried forward to future tax years. So it can be a great tax optimizer, not just in the current year, but in the years to come. We'll be doing this in your account over the next few months to make sure we harvest as much of these as we can. Any other assets you have elsewhere, you may also want to consider doing that before the year is through. Another aspect we manage in the portfolio at least once a year is the rebalancing of your portfolio. It's a good idea just to review the performance of the portfolio and remember that the main goal is, from our perspective, that make sure we're investing in a way that allows you to reach your goals while also not keeping you awake at night. So from a general standpoint, we tend to invest our funds for the long term naturally. The question is more about how much volatility is in line with your overall comfort level. In other words, if you're feeling jittery about the markets and you'd like to revisit things, it's definitely important to check in with us to just make sure that we're staying on track with things. For the next,
Josh.
Yeah, sure.
Stay on that page just for a second.
Yep.
For tax harvesting, what happens if you live in a country where the actual capital gains are due in that country instead of the United States? Should we be making different considerations when it comes to the tax, i.e. the currency?
Yeah, absolutely. That's also a good point, Brian, is that it's not just about the dollar, but also your local currency. So it can be the case that you want to be considering what is the impact of a gain or a loss in, say, euro or pounds, wherever you're living. So there's a different dimension of that you'd also like to be considering. And even if you wouldn't be normally considering it, it's something you might want to check in with your accountant about as well, because they might find that really useful information for their tax aspect also. Perfect. So another aspect that we manage in the account, well, the second thing, sorry, to move on from that slide, is to do with retirement contributions. Now, contributing the maximum allowable amount to something like tax advantage retirement accounts, now the most common one being IRAs and such, would reduce your taxable income in the States and just make sure you're putting away funds for retirement. If you don't make these by the end of the year, don't worry, because you can contribute to IRAs until tax day of the following year. For 2024, that's April 15th. I would just confirm that you're eligible to make those contributions and that you're doing it within the limits relative to your earned income. On the other hand, if you're retired, you want to make sure that you're taking, or you plan to take, your required minimum distribution, also known as an RMD. If you have a relevant retirement account for that, like a traditional IRA, for example, there's several resources you can use, because a common question is, well, how much do I take for my RMD? If you go to the next slide, I think we should have a screenshot of that, of just the IRS website there. Yeah, so that's just one place, one such resource you can go to just calculate it. There's a few of them out there, but this is something where you'll just need the basic information of a balance at year end, etc. And if you need any help with this, or if it's from an account that we manage and you just need it sent out and calculated for you, just feel free to reach out and we'll be happy to assist. We just want to make sure we do that before year end. We can go back to the previous slide there. No, sorry, just two back now. Yep, go back. Perfect. Okay. Lastly, also consider any gifting strategies that you want to make use of by year end. So in many countries, the deadline for this is December 31st. So it's something you'll want to think about over the next few months, especially if you either plan to be gifting to loved ones, friends, others, charities, if you plan to make charitable contributions. The main aspect to keep in mind there is, like we talked about just now with the capital gains and such, is it's not just about the US side. You're also wanting to mind any exemptions or other rules on the other side as well, where you're living. So that of your host country. There's a couple of examples on the slide here, like in the UK and France, although obviously if you're somewhere further afield, just make sure you're complying with your local exemptions and regulations as well. So there's a few high-level items for us to just start to revisit and take stock of, but my colleague Isa will just take us through just the next portion of it now.
Absolutely. Thank you, Josh. So one thing that we also encourage you to do at least once a year, but ideally even multiple times per year, is reviewing your balance sheet. So this is an essential part of your financial plan, knowing where your money is and where it's working for you. On the right side on the slide, you can see an example of a balance sheet and how it's structured, basically from the most liquid account to the least liquid. And that gives you a really great idea of how much do you have in investments, how much is in cash, and also one thing you definitely want to look at is how much of your cash is actually in accounts that are earning interest, and how much is just sitting there doing nothing and can potentially be invested or be put into an account that is earning interest for you. Generally, the budgeting that you want to review is very simply how much are you spending versus how much are you actually having an income. You want to make sure that those numbers are met in a way that you're not exceeding your income and incurring any liabilities there. We strongly encourage you also to have an emergency fund. So the guideline is always to have 3 to 6 months of your normal monthly spending in cash or in a very accessible way, so that if you should have no income for some reason, for example, you lose your job or anything can happen, that you have these savings and that you're safe for at least 3 to 6 months. And during that period, you don't have to worry about cash flow issues, but can focus on making sure you have income again. Another thing is also repaying debt. So that's also a nice thing about a balance sheet. You can also clearly see where is your debt. Do you have mortgages or loans or debit cards that you have to pay off? Each of those have different interest rates, and it makes sense to pay off the ones with the highest interest rates. For example, credit cards tend to have a really high rate, so you don't want to sit on that debt for too long, and that's kind of something that you want to pay off first. Whereas a mortgage, for example, has often a very, like a way lower rate than a credit card. So that's kind of something that we don't mind having for a longer period of time. Credit checks are a very important thing to consider once a year, at least. On the US side, there are various websites where you can check your credit score. The benefit of that for you is that you can see whether there has been any activity going on that you don't know about. So in the US, it's not uncommon, or not uncommon. It doesn't happen that often, luckily, but it's not impossible that there's identity theft. Checking your credit score is a great way to make sure that there's nothing unusual going on. And of course, if you intend to get a loan or mortgage in the US, you want to make sure that your credit score is okay. If not, you want to make sure that you kind of build your credit score and improve it and work on that. This is something that we can also help you with, generally your balance sheets and all these different items. So Ken, if you don't mind going to the next slide.
Yeah, that's an excellent point on the debt repayment aspect as well that you mentioned there, Isa. And when we get to the actual market update portion, Brian and I will be discussing interest rates in much more depth as well. But definitely points to keep in mind on some of those high interest bearing debts.
Mm-hmm. One thing to consider in your general financial plan is also your estate plan. Again, this is something towards the end of the year is a great time to consider that. Do you have any wills or trusts? If you do, are they up to date? You want to check that on a regular basis. If you don't have any of those, you want to take some moments and review whether those make sense for you or whether your estate plan is in line with, based on the country where you are, with what you're looking to achieve. Beneficiary designations are another important thing. If you have an IRA or any kind of retirement account, really, those always have a designated beneficiary. Make sure those are up to date. If not, you can easily change those and get those updated. And when we go to the next slide, there's also a couple of miscellaneous things. So one thing to also review is your insurance coverage. What kind of insurances do you have? are they still the most appropriate for your situation? Are there maybe insurances that you don't need, or are there certain insurances that you should have but you don't have? So this is always something that you want to review as well, to make sure that you're protected in the best way and the most appropriate way for your situation. And then general financial goals. Do you have any big projects that you have in the next years or next months that you want to prepare for? So it's kind of, we all have long-term goals or short-term goals. So it's reviewing those, reviewing how are you on track with meeting those? Are there things that you can do more efficiently? So that also flows into the whole budget and cash flow plan. Should you be saving more? As I mentioned, paying off the debt, these kind of things is something that's towards the end of the year is always a great time to review that for the next year.
Perfect.
Okay.
Perfect. Thanks so much for the end of year planning aspects there, Isa and Josh. Now we move on to the actual agenda here at hand for the wider quarterly update. So again, we're going to be breaking these down into three key aspects of what's actually going on here, what does this mean, and why you as end clients should actually care about some of the aspects that we'll discuss here. And actually, there's a lot to cover here. So again, if you do have questions, like I said, please do post them in the chat, and we'll be getting to them throughout this session here. So with that said, actually, Brian, if you're still around here, why don't we move on and actually look at what's going on here, and start with the inflationary aspect, really, because I think that's really taken the headlines center stage in the last few months. So what's happened in that arena in the different parts of the globe?
So what is the inflationary part supposed to be represented by the balloons in this picture?
Absolutely. It's wonderful that
up.
you can always get the analogies I subtly try to put in the slides, but spot on.
And then you run out of gas a little bit, because oil prices start going up, and then it starts to fade down into it. Are you in China there, or someplace in Southeast Asia?
Someplace where there's inflation, which moving on to our slides here, why don't we unpack first of all what we're looking at here, and secondly what the significance is of some of these changes that we've seen, and whether we're actually headed in the right direction.
Well, inflation is kind of across the board been the only topic we've been talking about on Wall Street all year long, and it varies so significantly from east to west, but it looks like it's being controlled in certain places. That's where we look at from the kind of summer view. We've got U.S. inflation that looks pretty much under control. I know this screen looks really small, so I'll give you kind of some dictates. Over the course of the year, we were closing in on those double digits. We got to a high in the U.S. of 9%. We're back down to 3.67. Our historic inflation should be around 4%. We removed the 1970s that were crazy because of the oil crisis. Essentially, we're down to a long-term average of 3%. And our central bank, the Federal Reserve, would like it to be closer to 2%. Might be a pipe dream in the near future, but that's what they state. So the U.S. looks like it's coming under control, and one of the big factors there is that they're able to control their energy policy through shale oil that came along about a decade ago.
Yep, the shale revolution, I think, really drove home the energy independence for the US, and I think Europe is probably at a similar juncture where they're having to learn their lessons the hard way, unfortunately.
Well, but Europe, we've got to remember we've got 27 nations that are kind of combined into the European Union, and then you have these periphery nations over there. So when we look at this number that scaled over 10% during the year and now is down to 5.2%. We have some countries like Germany and France that are struggling in the upper 6th percentile range. But then the Netherlands, Belgium, and Spain, of all countries, seems to have their inflation under control. And that seems to be more based on energy policy than anything else. France had their inflation under control at the beginning, and now they're struggling a little bit more. It seems anybody that has their energy policy taken care of is able to handle this inflation a little bit better. The UK is definitely the anomaly right now. The numbers seem to continuously come out much higher than expected. But we'll go kind of tale of two cities. That's the West. The East seems to have the opposite problem. We're basically talking about needing inflation. Well, we've needed inflation in Japan for 20 years and starting to need it in China. Essentially, we're looking at policies over there that can instigate inflation, like printing money. Whereas in the West, we're looking at the exact opposite. We're trying to slow down our economies to get that inflation under control. So it's not a global problem. It's a Western problem right now. And that can probably be explained more through the energy policies that we'll talk about on the next slide, I believe.
Mm-hmm.
If I remember the order.
Absolutely spot on. And speaking of energy, I think one of the things that's really grabbed headlines in the last few weeks has been what crude oil has been doing. So if we move over to the next slide, before we dive into what's actually going on in this slide, first of all, Brian, why don't you give the audience here some contextual background on why the price of oil is important, even though we might not have direct exposure in our portfolios, and then we can back into there of, well, what's oil done recently? Because when we made this chart, it was sort of in the $94, $95 a barrel range and fast approaching 100. And well, today it looks like it's down quite dramatically and it's back down to 86. So again, an extremely volatile week. But why don't we unpack first why our audience should actually be paying attention to what the price of oil is doing?
Well, if we start with the why, oil basically resonates in everything that we do. Doesn't matter if we're producing something or just utilizing energy in some way, shape, or form. Oil kind of seeps into just about anything, which is why it's excluded from inflationary figures, because basically it will play into it 6 months later. And that's to where it can be very volatile, but it plays out over the course of time. If we have heavy energy costs, it will cost society a form of a tax, as they would say. So we need to be vigilant of this. Now, there's two sides on the earlier portion. We basically have this news that the Saudis and the Russians are reducing their supply. If we reduce the supply, essentially the price should increase. Now, the discussion that Cam and I had the other day was, if you reduce the supply, now all of a sudden the price goes up. If the price goes up, then we have a tax on society, and all of a sudden we slow down our economy because too much of the money is going towards oil, which slows down the actual demand for oil, which should reduce the price back to that equilibrium. That's that perfect capitalistic society. When we discussed this 2 days ago, Cam, I did not expect it to play out so quickly as you just said.
I know it's shockingly frightening how fast some of these commodities, particularly oil, in the last couple of trading sessions has moved. But it's, as you pointed out, you can only artificially prop up an asset or a commodity for so long before I think even the cooperation goes out the window, and all of a sudden you start to have some cracks in the OPEC plus cartel. But anyhow, that's a different conversation for later.
Well, I think some of these countries, they have a need to drive enough income from their commodities
absolutely
to actually support their economies. The IMF actually publishes their vantage point of what their opinion is that the Saudis would need to have oil prices at to continue driving their economy. And the last figure was $81 a barrel. So anything below $81 a barrel, basically Saudi Arabia cannot actually continue to run their economy as is. Now, they have a few projects going on, and essentially that number will probably gravitate higher than $81 a barrel, because these are mega projects. They're quite fascinating. They're quite fun. But they're also quite costly. Russia has other things they're spending the money on that we don't have to delve into deep, because I'm sure everybody in the audience knows exactly what we're referring to. And naturally, that's to where reducing the supply and increasing the price can actually help drive more profit for them in the near term. Naturally, this is going to be the driving force on what ends up being the inflationary numbers going forward. And that's going to be astronomically important, because if we can't get those inflation numbers down, we can't think of a time that we can at least hold interest rates steady for long periods of time, or even drive them down if the economy needed them to do so. So that's why this oil figure is so important.
Perfect. So we've touched upon inflation there, Brian, and how oil plays into the picture into this. Then I guess the next natural move forward is, well, how do central banks, well, first of all, what is a central bank, and how do central banks fit into this picture of getting inflation down, but at the same time ensuring stable market conditions?
Well, the first and most important part, duty of a central bank is to keep financial control. We put out our newsletter last night, and it actually shows the directives of each of our major central banks in the West are just a little bit different, but it's keeping financial control. And one of the aspects of keeping financial control is keeping inflation in check. So that's its main directive. These are not individuals, like, for instance, in the United States, they are not voted in any way, shape, or form. They are not elected officials, and they're only trying to control financial stability, not trying to conjure up votes. So we shouldn't misalign that our president is aligned with the Federal Reserve. They're separate bodies that work in separate interests from those vantage points. So when we look at our central banks, they have their directives, but their main target is inflation right now. And that's the main thing they have to concentrate on. They don't care if they do away with growth, if it means that they can do away with inflation.
So we've sort of unpacked there on a high level what a central bank is. Why don't we actually look at what the central banks across the various jurisdictions have been up to in the last 12 to 18 months? So why don't we first of all unpack this slide here that our audience is looking at, Brian, and then why don't we look at some of the moves these various central banks have taken and possibly their direction going forward?
Absolutely. Well, we always joke that in the past, the central banks always go in their same order. The U.S. goes first, the U.S. is lapdog, so they get to go next, then Europe, then Japan, and when China does it, essentially they're a bunch of tax cheats. And if you look at those charts, the U.S. comes first, and we have the highest rates at 5.5%. The Bank of England at 5.25%, 4.25% in Europe. We just got a rate cut from Poland. So they're coming back down towards those European levels. They're at the 5.5% level. Japan, that big anomaly, at negative 0.1, trying to stimulate some growth over there and doing a good job of it. If you look at the stock market from that vantage point. But China down there lowering interest rates instead of raising interest rates, because they have no inflation there. They need to stimulate some growth or essentially protect some of those real estate ventures that have gone awry. So you can see those steep lines. That old adage of those 5 has held true. And that's where if you have a mortgage, you might have noticed that if it's on a variable rate, those rates have gone up significantly. But if you have a savings account, it should have gone up. And if it hasn't, you should be looking around for some place that's paying you closer to these figures in your respective area, instead of maybe the lower rate that you've gotten accustomed to for all of those years.
Absolutely perfect. And I think one of the anomalies that you mentioned there, Brian, as you pointed quite rightly pointed out, with Japan persistently keeping rates far below where they should be, even though they've finally got the inflation they were after for so long. But it's a bit of a mystery on why they still insist to maintain rates so far from their Western peers. And potentially, I guess, any shift in that status quo could potentially have some ripple effects on the other central banks as well.
Absolutely. It's been the big mover. It's been the big trade that a lot of people have played at the beginning of the year. It was all the talk that Warren Buffett was finally buying things outside of the United States, and his first really big endeavor was Japan. I think it's going to continue to be the story, and we're only in the first half of the story. As you've pointed out many a times, Cam, once that trade turns around, unwinding it is going to be a difficult process, maybe reminiscent of the UK in the past.
Indeed, it is one of those where it can change on a dime, and when it does, it tends to move very, very violently and very quickly. So again, that's something we're keeping a close eye on as well when it comes to the interest rate dynamic, which actually moving swiftly along, because I know we're running a little short for time if we want to have plenty for Q&A for our audience. So we've discussed what's actually going on here on a higher level, Brian, but what does all of that actually mean? Now, we've briefly touched upon interest rates there in the different jurisdictions. Now, the next slide here that we're looking at is focusing on the US yield curve. Now, naturally, both Europe and the UK have something very similar going on as well. But what's actually going on with this chart? Why does it look a little funky? And why should clients be paying attention to it?
Well, let's first explain what the chart is. The yield curve is the simple premise that the longer you lend somebody money, which is what's going on the x-axis, essentially the more you should get paid, which is the y-axis. So last year is in blue. Essentially, if you lent somebody money for a year, you would get paid less than if you lent them money for 30 years. The green line is what's going on today. So you get paid more for lending people money for a short period of time. This is what is called an inverted yield curve. Many of the newspapers will describe this as the cautionary tale that a recession is coming. I would make the argument that it more causes recessions instead of prognosticates that it's coming. So essentially, if you're lending money short term, people are expecting the overall economy to come down, and therefore interest rates would come down, and therefore you'd be reinvesting it at a lower rate. That is what a lot of the street is examining. That being said, we're getting much higher interest rates than what we should by buying fixed income, especially short term. So if we think about general financial planning, we should get 1 to 2% on our cash, 4% on bonds, and 8 to 10% on equities. That is the typical distribution that we would expect over long periods of time. I'm talking 25, 50, 100 years. Now, what's happening is if we're getting closer to 5.5% on our fixed income, we're able to get a larger allocation in our fixed income, but accomplish the same goals long term without having so much invested in equities. That's what gives us this nice little shift from a risk reward basis in the near term, to be able to allocate a little bit more to that fixed income side, because we're taking advantage of this anomaly of having an inverted yield curve for this short period of time. If next year the yield curve normalizes, those short end bonds can be reinvested into longer term bonds at those better rates. But if it doesn't, there'll be opportunities to buy a discounted equity market. So we're in a little bit of a win-win situation there if we don't mind the changing of the allocation in the overall portfolio. But essentially there's not value in buying deep bonds, 20, 30-year bonds. Today, actually, it shifted today that a 30-year bond yields more than a 10-year bond. But as you can see, when we did this chart, it was the opposite. You got more for a 10-year bond than you did a 30-year bond. So it's a weird progression, but we would expect to be able to take advantage of it as long as you're working the portfolio to that extent.
No, absolutely. I think with fixed income in the coming years, it's going to be very important to be strategic with your allocation, as you mentioned, Brian, managing that duration, but also the currency aspect as well. And the reason this particular slide has made many a different cameo in our various newsletters and updates as well is, I think one aspect that the audience needs to remember is, bonds haven't been as attractive as they are today for close to what, 2 or 3 decades, right, Brian? Where we've had interest rates do nothing but go down for the previous couple of decades.
Since 1982, interest rates have been going down.
Since 1982, there you go. Brian coming in with the save and fact checking me with the numbers. It's one of those aspects where going forward, from a risk adjusted perspective, I think bonds will continue to make they should have a significant part in any client's portfolio going forward as well. Switching gears here a little bit, because I know we're running a little short for time. We're going to be jumping right into, why should our end clients actually care, Brian? So how does this actually affect them? We've discussed the interest rates, we've discussed oil, we've discussed what central banks are doing across the globe, but why should our clients care? And we're going to be shifting onto the next aspect, which I think affects most, if not everybody, on a day-to-day basis, which is the currencies. So if we move over to our next slide here, and we look at, we've got the British pound to US dollar, and we've got the euro to the US dollar. So why don't we unpack what's going on here and potentially what the future trajectory holds for these two currencies and why clients should be paying attention to these currencies?
Absolutely. Historically, a currency should really move based on 3 factors: monetary policy, fiscal policy, and growth rates. That's the historic basis. Right now, in the short term, they're moving based on just one clear factor, which is interest rates. Interest rates are driving the movement because essentially the big money is shifting and hedging their positions. In other words, if we can get interest rates at a higher rate in the United States and hedge back to euros for cheaper than the differential of what European interest rates are and US dollar interest rates are, guess what? All of the funds are going to flow to the States, and then they're just going to hedge it back to euros instead of buying euro bonds at those lower interest rates. If interest rates in Europe catch up, so if you can actually go back several slides to show the number of interest rate hikes in Europe, the US, and the UK, if we look at those, you notice that Europe started well after the United States. And Europe has had 10 hikes, 11 for the United States, but they went from 0 to 4.25 instead of 0.25 to 5.5. So the Federal Reserve went faster and sharper, but started earlier. And they've controlled inflation. Now, if Europe gets up to the same levels as the United States, I'm not saying they have to. If they control inflation beforehand, they won't have to. But if they get over to the United States, we would see a large flow of capital from US dollars to euros, which are all those institutional individuals that are buying US dollar denominated bonds and then just hedging it back to euros. So this will be that big moving factor. The euro then could actually get to a very respectable level, and we could be looking at a near-term trend where we would have a 10 to 15-year period of the dollar actually declining. The UK is a little bit of a different story. The UK raised interest rates more than the US. So the Bank of England had to play catch up. they started almost as early as the United States, but they had an extra factor that Europe didn't have to take into place. They had the same supply chain issues from COVID. They've had the same oil issues or energy cost issues from the Russian invasion into Ukraine, but they also had all the Brexit issues. And I don't think the Bank of England took those into consideration, that it's harder to fight something that's political, that's causing inflation, than it is just supply and demand issues like the US and Europe was facing. That's meant that inflation has remained quite a bit sticky. And some of the numbers that are coming out here in the UK show that it's going to continue to be sticky. We have 14%, I believe. It's definitely double digits. It's maybe not 14, it's maybe 13% growth in rents in the UK. And when the average person spends 40% of their take-home pay on rent, if that goes up 13 or 14%, it's hard to control inflation. It's hard to keep it down at 3 or 4%, or their goal of getting it back down to 2%, when such a big portion has gone up in double digits. You add that to the energy costs that we were talking about earlier and all the issues that the US and Europe is facing, they're not able to contain that in any way, shape, or form. But the scary part is how it's affecting the pound. Because when we look at, say, emerging markets, when they raise interest rates, essentially it's supposed to attract capital until it soon scares it off. And that's what we've seen a bit with the pound. It attracted capital, and now it's starting to scare it away. People are not attracted by the higher interest rates in the UK to hedge it back to other currencies. Instead, essentially the capital flows leaving the country, because it goes back to what is going to be the long-term view: monetary policy, fiscal policy, and growth rates. And that's why you see the politicians here in the UK basically saying, let's cut expenses to cut our debt, and let's go ahead and cut taxes. I mean, all of a sudden we're hearing Liz Truss talking again and saying, get the corporate tax rate from 25% to 19%. You know, this failed a little bit last October. Let's try it again this October.
I think there's something about unfunded tax cuts that just rile up every sane economist out there, that for some reason or the other, the politicians just can't seem to grasp their head around. But maybe that's why the two of us aren't politicians at this point.
And it works just the same in the United States. Right now, we have more debt than we've ever seen in history. And there's a few on the radical right that are holding up the budget. They've held it up. Now we've delayed it to November 17th, but they've kicked out the Speaker of the House. Now, if that debt becomes uncontrollable and people don't trust it, then the capital flow is going to move out instead of moving in. So it's one of those problems that we have in the West, is that we have a little bit too much debt. We shouldn't just think that this is a Chinese problem. This is a Westerly problem. And hopefully we'll get the inflation under control so that we can keep interest rates down, so that we can get back to growth and controlling it the best way, which is growing our way out of the debt. But in the meantime, we are going to see those three main currencies shift significantly based on the interest rates in the short term, and then go back for the long term based on monetary, fiscal, and growth rates policies. And that's why people are paying attention to that on the long run, and it's affecting the British pound differently than it is the euro.
Absolutely wonderful insights there. We're just going to change tack a little bit and jump right into the equities portion, and then get to real estate before, if we have some time, then we can take a deeper dive on some of those fixed income aspects as well. So moving along, Brian,
You just want to get to the tough questions because it's been a tough month.
Absolutely. I want to make sure our audience has the full 15-minute allocation to ask all their hard-hitting questions and every curveball they can throw at you. So with that said, one of the curveballs has actually been the equity markets this year, right? So coming into 2023, nobody expected inflation to actually be under control somewhat in the different regions, depending on who you ask. And nobody, least of all, expected the equity markets to actually stage such a remarkable recovery, at least compared to last year. So why don't we first unpack the slide here that we're looking at? What do all these bar charts and different colors actually mean? And why have the equities continue to defy gravity, as some would say, and steadily march higher despite everything else going around us?
Well, let's actually start with one other piece, if you don't mind, Cam. Let's start with why it's been such a horrible month. September is historically the worst month of the year on an annual basis. You hear me say that all the time. January is historically the best. September is historically the worst on average, and this September was dismal. It proved it. Now, a lot of the reason was essentially people finally believed the Federal Reserve that interest rates are going to remain high. This is what Powell has been saying for the entire year, but they finally believed it. And that reflected on that yield curve that we discussed significantly, but it also affects the financing of companies. It also affects how people, and not just us, are investing in companies. When we're saying we're going to put more in fixed income, we have to take the money out of something, and it's going to be the equity side of the portfolio. So it's kind of shifted about, and it's all based on that mentality that interest rates are going to stay higher for longer, right? Now, that doesn't mean that the underlying value of what we're buying a stock has significantly changed, because what we're buying in a stock is what they can generate in earnings. And this is why this is such a powerful slide that JP Morgan puts together, where it goes through what the earnings are on the left-hand side of all of the S&P 500 from year to year. And so you can see in green, it shows each of the years where earnings went down in those given years. But over the course of time from 1988 all the way until 3 years into the future, we've got a huge upward trajectory. Actually, 3 years into the future, that's analyst estimates. And you want to take that with a little bit of a grain of salt. But essentially, those are going to be pretty accurate for a few different reasons. We talked about this on the last quarterly review. One of the big things is that companies are earning more money this coming year from last year because they've let a lot of people go or they haven't hired to replace people. We're looking at lots more efficiencies with companies. We're looking at the tech firms letting go nearly of 250,000 people because they overhired during the pandemic. And those extra reductions in costs make them more profitable. So there's two ways to grow the earnings in a company. One is to improve top line, i.e. improve revenue. And the other is to reduce costs. And this year, what we've seen is a ton of reduction in costs. But what we talked about on currencies, if currencies go down, if the US dollar goes down compared to euros, yen, pounds, etc., 60% of the technology companies and 40% of the S&P 500's earnings come from abroad. So when the dollar goes down, they end up making a lot more. This really tells you that the street expects the dollar to go down in the next couple of years and expects those reductions in costs to stay embedded inside of the companies, let them grow once the economy recovers. But the long-term trajectory is what we're after. And that's what really counts, what the companies are earning. And that's why we're not running for the rafters, knowing that the actual stock market is different from the general economy.
It's a wonderful summation there. We're going to skip past the real estate side, if you don't mind, Brian, and we can revisit that if we have some time. But I just want to summarize everything that we've just sort of unpacked here for our audience. So we've gone through the macro, we've gone through the micro, and we've also gone through some financial planning aspects in the beginning from Isa and Josh. Now, the important aspect that I'm sure most of our audience here is sitting and waiting is, what's the key takeaway here? What have been some of the changes that we have made in our portfolios in the last couple of months, and potentially going forward? What are some of the structural shifts that we're keeping an eye on?
Well, in simple form, the world has gotten back to normal in significant ways. We're no longer on this 4-decade trajectory where interest rates are only going in one direction, which is down, which made leverage king. Anytime you could borrow money and put it into anything, you were fine. So the most leveraged asset class out there is by far real estate. And beyond just them having leverage, they're getting hit with the kind of triple whammy that interest rates are much higher. People are reanalyzing how they use commercial real estate spots, or after the pandemic, how many vacation homes do you want to own that you rent off on Airbnb when potentially the government could keep you from having any guests in those homes for a couple of years. But also, they're coming off an expensive pricing. In other words, they were expensive pre-pandemic. They're expensive now with higher interest rates, and people reanalyzing how much they're going to go to the office or anything else. All of a sudden, real estate is going through a horrendous time. We have removed them from our portfolios until they can stabilize. We think that there's a lot of disruption there. We're not predicting a China-like sell-off where Chinese real estate, some of them are down 70% or so. Which it's a little bit of a bloodbath out there. We're not predicting that, but essentially we could be going through a real rough patch. And historically, we only owned real estate for the dividends, and the dividends are less than what we can buy a 1-year CD. So why on earth would we buy a risky asset class that's not paying us the main aspect as much as a 1-year CD? So we've removed real estate from all of our portfolios, and we've increased our allocation to fixed income. Fixed income on that short end is just much more attractive, because if we get anything above 4 long term, we're actually reducing our risk but keeping up our returns. Doesn't mean we want everything in fixed income, but a higher proportion than what we've ever historically had over the last 12 years. So normalizing the overall concept, you've seen it over the course of the year where we've gotten out of closer to alternatives in convertibles and preferreds. We've reduced our emerging markets to a lower amount, and we're just getting to a more simplified fixed income in your home currency, equities in good large cap values. No need for anything exotic inside of the portfolio.
Excellent summation there. And as Brian mentioned there, it's not that we're overtly pessimistic on real estate, because mind you, there are pockets of real estate that are still quite attractive. I think, Brian, you and I have this conversation almost on a weekly basis, how some of the logistics hubs and data centers and server farms again are positioned quite well to continue to do well into the future, just because of some of these disruptive themes that we're seeing from AI and increased e-commerce penetration. But real estate as a whole, it is a little bit more precarious just because of those higher financing costs, but also the higher than expected vacancy rates, as we mentioned. Excellent. I think that's it for our update. So we'll be opening it up to the Q&A right now, and we'll see if we have any questions. And as we're moving over to the Q&A segment, I just want to end off here with a nice little quote from Arthur Godfrey, which is that he's rather proud to pay taxes in the United States, but he just wished he had to pay half the amount. So speaking of taxes, I think there's some developments possibly in regards to a bill, if I'm not mistaken, Brian, in the US about taxation and for American expats in particular?
Well, don't get overtly excited about this.
Because it's just a bill, right?
Oh God! Oh, Josh has been singing these songs a little too often. If we can get you to sing that the next time, I will pay double for my admission to this webinar. The reason I say that we shouldn't get overtly excited is it doesn't structure any changes when it comes to PFIC rules, FBAR rules, or any of those. What it would really do is it would reduce the opportunity to force people to pay taxes from abroad when they're in a situation like a university student or making a de minimis amount to be forced to do so. So if we had investments, we still wouldn't want to have the investments outside of the United States, because then we'd still have PFICs. And then if we have US investments, then we still have to do our taxes. So it's not something that saves everyone, but it saves those guys starting out after university not having to file their taxes for a few years until they get themselves up and going, which is always an improvement from where we are. That being said, it's still a great thing to support organizations like the ACA and the like, so that they lobby the government so that they can better understand the burdens on us. But it's going to be a long, hard fight.
Got it. So as mentioned, ladies and gents, please put your questions in the Q&A function, or just feel free to send it via chat as well. We've got a couple of minutes so we can take a few questions here.
I like the first question that Jennifer's put in there.
You're right. We do have a first question from Jennifer, which is, she's actually in Japan, and should she be buying as much yen as she can in the short term? What are your thoughts there, Brian?
Well, it should be the opposite. She should be borrowing as much in yen as possible and investing it in any other currency. That would be the typical carry trade for the longer term. But that being said, it's a fun speculation that works when you're able to leverage it on other people's money. As you can tell, we haven't jumped knee deep into that side of leveraging everybody's portfolios with carry trades, but it is an interesting premise.
Indeed, I think it's one of those aspects where you want to reduce the risk as much as possible, and if your future cash flow needs are going to be in yen, then it probably makes sense to have a little bit more yen than any other currency. But again, not to get wild and excited and carried away at the other side of the pond there. But again, everything in moderation.
Absolutely.
I think we've got a little bit of time here. Just we'll see if we have any more questions. But one of the slides that I found quite interesting here, Brian, was particularly on the real estate aspect, which I know you and I have been discussing many different times. And I know I did mention we'd revisit it if we had some time. But when we look at real estate, both in Europe and break it down by country, but also compare it back to the US. Now, as you mentioned, we like to point our fingers at China with their real estate problem, but it doesn't seem all that particularly great here in the UK or parts of Europe as well, especially when we look at it from an income perspective. What are your thoughts there on real estate as a whole here in the UK and Europe, and potentially how that could impact the trajectory of interest rates as well, which we touched upon from those various central banks?
Real estate, I mean, you can see from this chart. So first of all, this is a chart from The Economist that I find wonderful, and you can run it on pretty much any Western economy. And it's going to compare mark-to-market prices, which just go up based on what the last house was bought or sold for. And it's going to compare them to a percentage on rents and local incomes, because naturally, if you don't live in a house, how much can you rent it out for? It becomes a small business, and that becomes the important part of how would you value a house. The other part is the incomes, because anybody that doesn't have ample funds needs to make sure that they have enough income to support their mortgage. So looking at those percentages, you can tell whether a country is overvalued or undervalued for rents and for income. So essentially, both of them, the United States and the UK, have remained overvalued for close to a decade, just right around a decade. When we look at certain countries in Europe, like Belgium and the likes, it's been even longer than that. They didn't have those ripples from the financial crisis. Now, does this necessarily mean that we're predicting a crash in the residential real estate market? Absolutely not. That's not what we're stating. What we're stating is that as interest rates get higher, it becomes harder for that consumer that has a lower income to be able to purchase the property. So in other words, we have to have either an inflation in wages to control that, or a pullback in prices. You have to have an increase in rents or a pullback in prices. So it can go on both ends. So as I was talking about earlier, that it's going to be hard to control the inflation here in the UK because rents have gone up so significantly. When rents go up by 13%, it's hard for employers not to pay their workers a significant raise to control for that. Otherwise, they have to move out of town to control their cost of rent. And if they pay higher wages, that income side goes up significantly. So we're definitely having the pullback in residential real estate. The question will be, how much will be driven up by inflation, i.e. wage growth, and rent growth, and how much of it will be downside of real estate prices coming down.
Got it. Perfect as always. Full of wonderful insights there, Brian. We're slightly out of time now, so I think we'll just stop it here and round up. So I just want to thank our audience here for tuning in. Again, we will be sending a follow-up with the full recording so you can review it in your own time, as well as a full detailed copy of the slides and some of the topics that we actually weren't able to cover today. But with that said, I think we'll round it off here. Thank you all for attending, and thank you to all of our panelists here for the excellent session.
Thanks everybody for coming. Thank you, Cam, for hosting.
Absolutely, my pleasure. Take care, everyone.